Differences between LIFO and FIFO. LIFO versus FIFO. LIFO is an inventory valuation technique, in which the last received stock of goods is issued first. Whereas, FIFO is an inventory valuation technique, in which the first received stock of goods is issued first. The purpose of LIFO is to account for how inventory has been sold that records the most recently produced items as sold first. Whereas, the purpose of FIFO is to ensure that the first items entering an inventory are the first ones to leave when it comes time for shipping or sale, that helps to prevent wasting resources on old items and ensures that customers receive the newest stock possible. LIFO represents the oldest stock, whereas FIFO represents the newest or latest stock. The current market price in LIFO is shown by the cost of goods sold, whereas the current market price in FIFO is shown by the cost of unsold stock. IFRS does not recommend the use of LIFO for valuing the inventory in accounting, whereas IFRS recommend the use of FIFO for valuing the inventory in accounting. In LIFO, income tax shows minimum amount when there is inflation in the economy, whereas in FIFO, income tax shows a higher amount in inflationary condition in economy. In case of deflation, larger amount of income tax is shown in LIFO, whereas reduced income tax will be shown in deflationary conditions in FIFO. Cost of goods sold in LIFO are higher during rising prices as newer, costlier items are sold first. For example, selling stock bought at PKR 6,000 per unit. Whereas, cost of goods sold in FIFO are lower during rising prices as older, cheaper items are sold first. For example, selling stock bought at PKR 4,500 per unit. LIFO is ideal for storing homogeneous products that do not expire, whereas FIFO is ideal for moving perishable products. Ending inventory value in LIFO is lower during inflation since older and cheaper items remain in stock, whereas ending inventory value in FIFO is higher during inflation since newer and costlier items remain in stock. Profitability in LIFO is lower during inflation due to higher cost of goods sold. Profitability in FIFO is higher during inflation due to lower cost of goods sold. Tax implications in LIFO are lower taxes as profits are lower during inflation, whereas tax implications in FIFO are higher taxes as profits are higher during inflation. Real-life example of LIFO are coal or gravel companies, new material often shipped out first for ease. Whereas, real-life example of FIFO are grocery stores, perishable goods sold in the order they arrive. LIFO inventory valuation technique is allowed in some countries, like the US, under GAAP. Whereas, FIFO inventory valuation technique is widely accepted globally under IFRS, in UK, Australia, Saudi Arabia, etc. Simplicity of LIFO is more complex to implement and maintain, whereas simplicity of FIFO is easier to implement and understand. LIFO doesn't provide an accurate indicator or updated inventory value because the valuation is much lower than inventory items at today's prices. Whereas, FIFO is a better indicator of the value for ending inventory since older items have been used up while the newest items reflect current market prices. In short, LIFO is abbreviated to last in last out is an inventory valuation method that is based on oldest inventory items are sold or used first. Whereas, FIFO is abbreviated to first in first out is an inventory valuation method that is based on newest inventory items are sold or used first. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.